Today we have a special episode. We're going to go over the most common types of mortgage programs with the Mortgage Poo. Welcome to Fundamentals by the Mortgage Poo. Yay!
Woo! Hi guys, thanks for having me again. I want to just talk to you guys, educate you guys on different loan programs that there are, so that when you're going to buy a home, that you know borrowers should be informed of what different programs there are. So
Definitely be educated, and that's what we're here for. So, what would you say is the most common type of loan program most people would be able to qualify for?
So the most common would be FHA and conventional. So starting with conventional, if you have a credit score above 700, and you have a healthy debt to income ratio, which means less than half of your income is accounted for by your debts, you have more room basically.
No, you're
It's
good. You're
so
good.
hard.
You're good. You're good.
We're gonna cut this part out.
Let's dumb it down for the people.
Yeah.
Let's say you have $10,000. Explain from those numbers the debt to income ratio, how that works.
Okay, great. So let's say you make $10,000 a month. Okay. Now we usually take 50% of that
Mm-hmm.
as your monthly limit that you can be allowed for in terms of your major expenses.
Yeah.
So $5,000 would be your maximum, and assuming you have no other debt.
Does that include your mortgage payment as well, or everything outside of the mortgage payment?
So this will include your mortgage payment, your credit cards, major credit cards, personal loans, car loans, and student loans, anything that's on your credit report.
So in a way, you're really looking out for the client, where you don't want them in over their head if it's in a program that they can't afford.
100%. Before the financial crisis, actually, the reason the financial crisis happened was because loan officers were not licensed, where anyone could get a loan. If you ever watched the movie
I know exactly what you're thinking
The
of.
Big Short.
The Big Short.
Yeah, that movie, it showed a lot about how anybody was getting a house, even if their money was not showing that they could afford it, and then the rate would adjust and they would see the payment jump up and they couldn't afford it. So a lot of people went underwater and lost their homes.
The scene in that movie that sticks out to me is when that stripper was telling the businessman she has 3 houses and she's looking to getting a fourth.
And he's just like, what?
How is that
He's
possible?
like, there's something wrong. Yeah. So 100%, now we have to make sure that we're doing right by the borrower and make sure that they're comfortable so that we can prevent future housing crisis. God forbid, not going. But yeah, so let's say you have $10,000 income a month. You want to make sure that your major expenses are below 5,000. So that's my job, is to make sure that your income qualifies, your credit is good. Conventional would be good for that. Typically with conventional, you can put 3% down as a first-time home buyer, which a lot of people don't know. They usually go to FHA thinking 3.5% is the first-time home buyer loan, especially because FHA, for some reason, people think of it as first-time home buying something. Like people always think that way, but conventional has a really great first-time home buyer program as well. So 3% down for conventional, and then FHA is 3.5% down. The big difference between FHA is, I love FHA. They give more opportunity to people with lower credit scores. So let's say if you're at like a 680, 620, in that range, you're better off with an FHA loan. They'll give you a lower rate, but they have a mortgage insurance to protect the lender. So, it kind of ends up being the same. So people will say, oh, I want a 5.5, but then they don't realize FHA has a mortgage insurance on top of it. So, always make sure with your lender that you're comparing both options to see which one's the best for you.
Let's bring it back to the low credit score, because you would actually help the client of mine increase her credit score. Would you just like to explain how you did that and what you told her to do?
Yeah, sure. That was fun. But basically, if you have any collections on your account, there's always some tips and tricks that you can do to make your credit better. So one is, if you have any collections on your account, let's say from a doctor medical bill, hopefully not, or let's say Verizon, or one of these tech companies, they always want to throw something in there for a collection when you end their contract. So that hurts your score a lot. It's like an anchor to your score. So paying those off, you can even call them and negotiate. So let's say you owe them $200. You can call them and say, hey, I want to pay this off in full. I just can't afford all of that right now. What can you do for me? And they'll usually cut it off like 75% to 50%, of the balance, remaining. So you can save some money there and pay it off. Another tip is, if you have any friends or family members that have good credit or have a credit card that they pay off every month or they don't use too often, and their balance is low compared to their limit, mostly credit is dependent on your limit to balance ratio on your credit card. So if you have $1,000 limit, you don't want to use over 30% of $1,000 on that balance at a time, right? So if you have an authorized user that you can, like, let's say your mom has a good credit card and you can add yourself as an authorized user on that credit card. You don't even get the card, but their transaction history will report on your credit and boost your score up by like 30 to 50 points sometimes.
Well, is there a risk in the person whose credit card it is
No,
allowing somebody to be on there?
no,
No,
it's
no
not.
risk.
No. Actually, the risk is on the person that's being an authorized user, because if that person messes up, like the original owner of the account messes up on a payment or anything like that, then it hurts their score.
Oh wow.
Yeah.
Okay, so it can be a double-edged sword if done the wrong way.
Yeah,
Not
but
done.
you can always just remove yourself also as an authorized user, and then it goes away again. So
Is it really that simple?
it's a little hack, yeah. It's a little hack I
Little
learned.
hack.
Yeah, and that's my favorite hack, because if you have a 620 and you want to get up to a 650, I always tell people just add yourself as an authorized user on a couple cards and boost your score up that way. Also, pay down your balances, of course, 30% or less. That's the main tip. But yeah, FHA is great for people with low credit scores. You'll still get a really great rate. The mortgage insurance is in there, but a lot of times you'll see the payment still be less than conventional, because conventional will have a higher rate because they have no mortgage insurance.
Okay, so dealing with clients, I've noticed that when it comes to FHA loans, lots of times they don't qualify for certain houses because it needs to be of a certain quality just to get the house.
Mm-hmm.
Meaning there can't be too many things that need to be fixed. Certain things are just stricter when it comes to FHA program. With that being said, can you go into the pros and cons of an FHA loan and a conventional loan? You can start off with FHA, then circle back to conventional.
Sure. So with FHA, they do have a lot of restrictions on how the house has to be in terms of the shape of the house. Not literally the shape of the house, but in terms of chipping paint, they're very against that, because there was lead paint before, I think 1970s.
I think it was 78.
Something like that, yeah.
Mm-hmm.
So there was lead paint, so to prevent like any danger or hazard to your health, they want no chipping paint. If there is any, you have to scrape it off and paint it with a fresh little layer of paint. And if there's 3 or more steps in the house, it needs to have a handrail, for example. And FHA just wants the house to be in a good condition where it's not like, any issues that need to be fixed, really. With conventional, you have a little bit more leeway. They're not too strict with the appraisal. They'll let you slide if there's a little bit of chipping paint or the kitchen's not in pristine condition and things like that. So conventional has a lot more leeway with that. But there is one cool loan that I'll tell you about, FHA 203K, which is the rehab loan. So let's say if you're a first time home buyer and you're not even a first time home buyer, but you're buying a house and you're going to live in it, you can purchase a home based on its after repair value. And basically, the HUD will appoint like a counselor to see how much the construction needs, like how much construction is needed. So you hire a general contractor to tell you a list of things that the house needs. Let's say you're buying a house and it needs, new flooring, a new electrical, new roof, whatever these things might be. The general contractor writes it all down. We estimate what that amount would be. We add it onto the purchase price, and basically the buyer is paying that loan amount and that payment, but the money is being distributed to the contractor to make those improvements. So it's a pretty cool loan.
So is that added onto the loan, the amount of money that would be needed to fix the?
Yes.
Okay.
That would be financed. So it helps people a lot, because then right away you get to build a lot of equity in your home and you get to make it the way you want.
And would an investor be able to qualify for that, or is that just for somebody who's looking to live in the house?
It's FHA is only for primary residences. If you want to be an investor doing this, investors, there's actually a lot of cool loans for investors now. One of my favorites is the DSCR loan, the debt service coverage ratio.
Hey guys, we're back. And now the Mortgage Poo is going to talk about investor loans and investor programs that would be perfect for you.
Hey, so there's a lot of different types of new loans that came out for investors these days. So there's one called the DSCR loan. That's the debt service coverage ratio. What that means is, let's say you're buying a house, you're going to rent it out, and you don't show a lot of income. Or let's say you're a landlord, let's say you're self-employed, you write off a lot of your expenses and you don't show a lot of income on paper. So what you can do is you can use the rental income of that property to qualify you. And my bank actually, even if the rent doesn't cover the payment, we still have programs for investors that are, getting a property and the rent doesn't completely cover the payment we're giving. We can still make it work. So that's the pretty cool part. Usually you're going to see them put 20 to 25%, even 30% down for a better rate. So if investors, you have cash, not a lot of income, you can still make something work for you. Typically, you want to have around a 620 credit score or more.
Oh, that's doable.
Yeah, usually at my old bank actually it was 660. So I see a lot of banks require a 660 for investors. So I'm actually able to help you with the 620 and above.
Wow.
Yeah.
Not many people can do that.
Yeah.
Damn.
And then another type of loan for investors or self-employed people, we have a profit and loss program. So let's say you don't, again, show a lot of income on paper, you wrote off a lot of expenses last year on your tax returns. We can get a year-to-date profit and loss statement that tells us, signed by an accountant. It has to be signed by a CPA, but it can show your income for the past year to date, and we can use that to qualify you as well. We also have bank statement programs. So let's say if you, again, don't show a lot of income on your tax returns, then we can look at your past 12 months of bank statements and look at your deposits and qualify that as your income as well.
Can you explain the importance for an investor to have a good accountant and what they can do for an investor?
Yeah, so I mean, an accountant, their job is to obviously save you a lot of money in taxes. So thanks, shout out to accountants. You definitely want to save money on taxes. But when it comes to getting a loan, sometimes that can hurt you and deter you from being able to qualify for things. So having a good accountant that knows where to write off expenses in ways that loan officers can actually add income back, such as depreciation. If something is in depreciation, we can typically add it back into your uh, qualifying income, and other, a couple other places. But I'm not a tax advisor, so I can't tell you where to put them exactly. But if you ever have any questions, you're self-employed and you fear that you won't qualify for a home, definitely reach out and we'll make sure we find a program for you.
Cool. All right. Property out of state. Did you get a mortgage or did you buy everything in cash?
Oh, good question. I got a mortgage, a conventional loan.
Oh, okay.
Yeah.
Okay.
And at that rate, at that time, I bought a house in 2023 when rates were actually pretty high compared to now. They actually went down a little bit since then. So, regardless of the rate, and this is what I tell everybody, it's always nice to get a house at a fairer price, or a lower price, I should say. And you can get a higher rate. You can always change your rate, but the price you buy is kind of set in stone. So, buying a house at a lower price and a higher rate, you can always lower the rate. Rather than people waiting for rates to come down, you're actually going to see the house values be a lot higher because price and rate have an inverse relationship most of the time. And if the rates are lower, you're going to see a lot more buyers come out of the woodworks trying to get that house. So it's going to be harder for you to get your offer accepted and pretty much overpay sometimes for a property, which happened a lot during COVID. But thankfully, if you bought a house in 2019 to now, you're going to see a lot of your value appreciating, especially in New York. So that's a good thing because the rates have also come down since 2023. So when I bought my house, and I sold it 2 years later, I was able to make a good profit on it regardless of the rate.
Yes. And one of the things I wanted to ask you about is, well, I wanted to tell you about, then ask you about. So many people feel trapped because of how good of a rate they got during COVID. So even if they want to move out of New York or whatever state they may be in, they still feel like they have an obligation to stay just because the rate that they have.
Mm-hmm.
What are the benefits to moving out even though you had that low of a rate and going somewhere else?
That's a great question. Regardless of your rate, I know having a 3%, everyone's boasts about it. People have T-shirts with, "Oh, I have a 3%," and wear it at their barbecues, like showing it off. Honestly, a rate at the end of the day is a number on a piece of paper. It's more about your comfort, what you want to do. So let's say you live in Queens, you have $1 million house, and you have a 3%. Great. But what you could do is you could sell that house and buy a bigger house in Suffolk County, or not even Nassau in some places, but you can get way more bang for your buck, keep some cash in your pocket, and be able to move on. And a lot of times with refinancing, right? Let's say if you have a 3%, you don't want to move. Let's say you want to do home improvements. Let's say there's someone elderly in the house and you want to make a bedroom downstairs so they don't have to go upstairs all the time, or you want to make an extension to your house because you have children. people are so scared to refinance. But if you have a car loan with a high monthly payment, or credit cards, which a lot of Americans have credit card debt right now, which they don't want to admit, but it's there. So if you have other debts besides your mortgage, definitely look into restructuring your debt or refinancing, where you can actually lower your monthly payments while getting cash, and it's tax free. You actually increase your tax benefits also, because mortgage interest is tax deductible, whereas a car loan is not tax deductible. Credit cards are not tax deductible, so you're paying interest and you're not getting any credit for it. So if I take your mortgage, pay off your debt, save you $1,000 a month, now I can give you cash and still save you money. It's just making your money work so much better for you. And now you can get things done around the house, get more tax deductions, and actually after refinancing you get to take a little payment break. You don't have to pay for 1 to 2 months after closing.
Most people don't know that.
Yeah.
Most people do not know that. Most people don't know any of which you just talked about.
Yeah, refinancing is like the bad R word, like these days. Like after COVID, people are so scared of it, but it has saved a lot of people. I've taken people from 2-3% to 7-6% and saved them thousands of dollars still. So,
Yeah.
Put them in a better situation. It's crazy.
Yeah, I feel people get distracted by the percentages and certain optics that'll scare them before looking into the actual numbers and seeing how much they can save. This happens a lot when it comes to people who are renting, when really the best move for them is to look to buying a house, because they're scared of that total house payment, but they're so short-sighted where they don't look into how much they're spending on rent and how much is going to accumulate as time goes on, while essentially owning nothing.
Yeah, and you're paying somebody else's mortgage, so you can be paying your own mortgage and building equity. And then let's say, and a lot of people say, oh, I'm not sure where I'm going to live yet. That's why I'm renting, I'm feeling it out. If you're going to be somewhere for a job for a couple of years, it still makes sense to get a condo or, a little house, something, so that you can buy it, build your money into investing and sell it later.
It's funny you say that, because people say that they're not sure where they want to move, where they want to be, and then they end up renting for 10 to 15 years. And it's like, in all that time, you could have had something that you own, which is always an appreciating asset. One thing that I always tell people when they're interested in getting into real estate, whether buying a house, investing, whatever the case may be, I always let them know that real estate is an ever appreciating asset. Whether you lose or make money within the first couple of years, in 20 years, you're going to be happy that you bought today. So it's always a good idea to think about the long-term benefits as to what you're doing, whether in real estate or outside of real estate.
100%. And then there's, a lot of opportunity, not in New York, also in different states. If you ever wanted to invest, if you have money in your property in in New York, let's say you have a lot of equity, you can always use that equity to buy little houses in different states, just so that you can keep that as an asset for your kids in the future and pay for their college with that later.
Of course, I think real estate is one of the best things anybody can invest in, because
sure.
there's always going to be a need for a house. It's always going to be there.
Yeah, but I do want to say, like, another thing is the dark side of it, right? So, like, being aware of what you're buying and just making sure you take the proper steps, like due diligence, to inspect your house and make sure you know all the ins and outs of the house before buying, because you don't want to be stuck in a bad investment either,
Absolutely. So. One thing I wanted to ask you about are VA loans. Can you go into detail as to what they are and just different processes regarding them?
Yeah, so thank you. Shout out to our VA veterans. Thank you so much for your service. We appreciate all that you do, and we have amazing programs for veterans. So one of the major perks is that you can put 0% down when purchasing a house. I've actually helped a couple veterans do that, and they came out of pocket for like over a $700,000 house. They came out of pocket like $5,000, $6,000.
Insane.
Yeah, it's pretty
awesome.
It's
just good faith, right?
Yeah, good
faith deposit.
Yeah, so 0% down. You only pay for your closing costs, which a lot of times you can get a seller's concession for, and that would be the realtor that will be helping us with that. And then there's also no real debt to income ratio. Like, you can go up to 60%, sometimes even 65%. I've seen people go up to. So you have a lot of flexibility with getting an approval. And if you have a service related disability, there is a funding fee that's in the loan that's financed, just like a mortgage insurance for FHA. They have a funding fee for VA that goes in the loan. But if you have a service related disability, that funding fee is waived. So there's a lot of perks to using a VA loan. There's better rates typically for VA also. And we have some of the best VA products in the industry. So I would love to help any veterans that we have. Yeah.
I had a question in regards to VA loans. Are there any differences based off of your branch as to what you qualify for, or is it essentially just an umbrella that covers everything the same, at least in terms of
It's
branch?
all the same typically, but they do want to see that we look at the DD 214 to make sure that they're eligible for it. They need to get a certificate of eligibility from the VA to be able to use a VA loan. Typically, they have to be active for over 181 days. If I'm not correct, I will check on that. But there's a certain amount of time that you must be in active service for to be able to qualify for that loan.
And I have a question in regard to VA loans, but it also is in regard to just the regular want to be homeowner that's looking to buy a house. Are there any factors that can derail the process of getting one of these types of loans?
Most likely, I would just say make sure that you're upfront with your documents with your lender. Make sure you give them everything that they need. That would be, if you're a W 2 employee, that would be your W 2s for the past 2 years, your past 30 days of pay stubs, and your photo ID and mortgage statement for any homes you might already own. If you give all your, and your source of funds, sorry, that's the biggest one, is your source of funds. You want to make sure that for FHA, VA, or conventional, however much you're putting down, and for closing costs, you show the lender that you have that money readily available. Typically, we want to see 2 months of bank statements. There are programs where they only ask for one, but I always want to make sure we look at the bank statements. We look out for any large deposits. If there's a large deposit, would be considered anything that's more than 50% of your monthly income is considered a large deposit. So that can raise a red flag to underwriting. So make sure you give all your documents up front to your lender so we can be aware of what we need to look at and what the underwriter will look at so there's no hiccups along the road.
All right, well, that's our episode.
I
Thank
hope
you.
you guys learned a lot.
Yes, thank you for all your knowledge and information.
Thank you for all the questions.
No,
And
of course.
hopefully it helps out anybody. If anybody has more questions, you can always feel free to reach out to Ashiv or myself so that we can help you out with the home buying process and make it as seamless as possible.
Yeah, here at AP Productions, we're not only here to educate, but we're here to entertain. See you guys.
See you. All right, that was not bad. Easy peasy.